there so that you can actually see it if you need to. Uh, Flow chart is on page 38 in your book. Please turn to page 38 in your manual so you can see it. And guys, I want you to remember that if you look at the flow chart, starting from the very top, what you're looking at depicted there is 3 individual trusts. You have one trust that is for your flipper property, and then you have 2 other trusts that were for properties that you were keeping, long-term holds. All right, those trusts are your land trusts. The trust in the second row are personal property trusts, because this individual had a level of paranoia. He wanted more than one level of protection. So in this illustration, your personal property trust was the beneficiary of your land trust. All right. Personal property trust is the beneficiary of the land trust. All right. And then in the illustration, your LLC is the beneficiary of the personal property trust. All right. LLC, beneficiary of the personal property trust. Now, on the bottom row, that's if you want to get into complete estate planning. That's where you have your final beneficiary, which would be you and your spouse, who would be the beneficiary of your LLC corporation and all of your assets. And that's what we'll be talking about a little bit later, where you can form an A-B trust. Now, they're a little bit more complicated. You got to have you have to know a little bit more from a legal perspective when you're putting those together. We don't provide those documents for you, because what I would recommend, if you're going to get to that level, that you actually find a good, competent estate planning attorney in your respective area that can help you put all of this together and give you a schematic diagram and format for how you will have your estate plan. Okay. Going back to the slide, and we'll talk about this one shortly as well. If you look at the trust bank account, and I know some of you had questions yesterday about the trust bank account. Remember, this is an actual trust. Your trust bank account is a personal property trust. This is totally separate from the bank accounts that we would be the custodian of if you were a property manager and you had a trust bank account managing your rental properties. Matter of fact, while I'm right there, don't overcomplicate this process, guys. Your trust bank account is simply just a bank account that you opened. Checking account, savings account, or whatever. Just an account that you open and designated for the specific purposes of maintaining your security deposits. Simple as that. You don't have to complicate that process anymore. It's just a simple bank account that you're going to designate just specifically for the receipt of of your renter security deposits. All right, we clear on that? All right, we talked about creating the land trust yesterday, and we went through all the forms. We went through the land trust formation document, okay, which was pretty simple to complete. You put in the information, self-explanatory, the information we went through, and then, of course, you're going to go about creating your trust. All right, so we should be good there. Now, if you're going to create a trust with that's going to have a personal property trust as the beneficiary, that means you're going to create 2 trusts at the same time. So you're going to have to create your land trust, and then you're going to create your personal property trust right behind that, and you're going to link the 2 together to formulate your estate plan or asset protection plan in regards to those 2 trusts or for that one property. All right, so that's what you're going to do there. You also would do the same thing if you were going to do an actual partnership or joint venture with someone else. And we talked about that on yesterday as well. We said that if you wanted to have more than one person that was going to be beneficiaries to your trust, then if you want to do like a joint venture with someone, remember, you guys are not actually partners. You guys both just own or have a beneficial interest in an asset held by a trust. Okay? You have the beneficial interest in an asset held by the trust. The other thing that I want to talk to real quick was insurance. Insurance is one of the most important things that we do in regards to trust, because that's where you can mess everything up, guys. And so let's go to page 74 in your books. Excuse me, we're going to start on page 73. Okay, and on page 73, you're going to see your requirement is for insurance on your trust. And what I'm going to tell you there is that you're going to fill out a declaration page, and we will get more in detail with exactly what this actually looks like, and I'll illustrate it to you on the when we get to the subject 2 part of the training. But what you're actually going to do is fill that form out, and it's completely. It's just a few lines. You're going to name the trust as the insured, and you're going to name the trustee in the trust document, as you see in paragraph 2. And you're going to ensure that the trust name is reflected on the trust document or in the insurance declaration. Your trustee's name will be there. And then any individual, you have somebody that's operating in a management capacity, you will have them reflected as an additional insured. And then you will have your own individual names there as their interests may appear. Like I said, I'm going to show you illustration of that probably a little bit later in this afternoon, and you'll see how it's done. If you turn to the next page, page 74. On page 74, what you see is an actual declaration that you would see if you were working with your insurance company. So if you look at the policy, it says Terry Honest as trustee. The named insured is Terry Honest as trustee of the 123 Main Street Estates Trust, and gives his address, mailing address. Okay. You got your agent's name, your broker's name. You see the policy period on there. Because that property has a mortgage on there, it gives you the loan number as well as the name of the mortgage company. That's the mortgagee. And then it gives the address to the insured property. All right. It's pretty simple, guys. It's as simple as that. If you go to the next page, page 75. That's where you actually see the insured names again. It's called the Greater Forsyth Britt Homestead Trust there. And then it says additional insured. It has some names there as the additional insured. All right. Remember, you have to change the insurance when you put your property in trust, because once you title the property to the trust, you no longer own it. You no longer legally own it. The trust owns it now. All right. Got to be clear on that. Don't make the mistake of putting your property in trust and get to moving real fast and forget to change the insurance, because if you have an incident happen, fire, whatever type of damage that comes along and does some damage to your property, and you go to file a claim, remember what I said yesterday, that insurance companies are good for 2 things: collecting premiums and denying claims. and you don't want them denying your claim, and you certainly don't want to have a house that actually gets destroyed or whatever in a fire, and then your insurance company tells you they're not going to pay because you're not the owner of the property anymore. Okay. All right. Want to go back and talk about one other thing we talked about yesterday. I want to talk about before we move on, I just want to go into the LLC just a little bit. So remember, on your LLC, you're filing a separate tax return with the filings up with your LLC. And we said that we wanted a multi-member LLC as a minimum versus a single member LLC, which was considered a sole proprietorship or a disregarded entity. Remember, that's a biggie. If you haven't made a note about that, that's what you need to make a note about. If you have a single member LLC, it is a sole proprietorship or a disregarded entity. All right. Now, you can have a single member LLC that's designated to be taxed or elected to be taxed as an S corporation, C corporation. You can definitely do that. But my advice to you is that if at all possible, you want to be at a minimum partnership return, meaning you have 2 or more members, or an S corporation, particularly for most of you people that are wholesaling, because that's going to give you the ability to save money on taxes. Remember that once you do the formation of your LLC and you're going to file the Form 1065, that's your tax return that you file. That's your business tax return, U.S. return of partnership income, Form 1065. Okay. And that Form 1065 is going to aggregate all of your business activity on the first page. And then you're going to actually, the profit and losses from the business will actually go to the members of the company by virtue of Schedule K1, as you see illustrated here. So you would have 2 partners. One partner would get a K1 and the other partner gets a K1. And those K1s are going to flow over to your Form 1040, your personal return. All right, remember what we said yesterday. We're going to have a business return on one side and a personal return on the other side. We're doing 2 different things. If you actually elect to be a sole proprietorship, disregarded entity, you're only going to have one return, just your personal return with all the relevant schedules attached to it. And that's not where we want it to be. All right. Remember that 1040 is going to go over to what's called a Schedule E on your 1040, and that's going to reflect all of your businesses. So if you're looking on this slide right now, where you see the Form 1040 Schedule E Part 2, under that Part 2, there's going to, in Part 3 there, if you had multiple companies, each one of your companies would be listed there along with their amount of profit and losses. So if you had 3 companies, 4 companies, then you would have all of those companies listed on your Schedule E with just a total amount of profit and or loss reflected. End of story. Again, this is important because when you go to actually file, like I said previously, when you go to actually do your tax filings, one thing I don't believe I did say yesterday is that your business tax filings are different from your personal tax filings. Business tax filings are different from your personal tax filings. Other than this year, because of COVID-19, you know that our personal tax filing is usually due on April 15th of each year, unless you are granted an extension. And if you're granted an extension, you can get a 6-month extension. And if you get an extension, then your personal return is due on October 15th of each year. All right. Your business return is due on March 15th of each year. Write that down. March 15th is when you do your business filings. That's when they're actually scheduled and due. All right. If you get an extension, then they will be extended up to and through September 15th of each year. That's important. That's important to know. All right. Be mindful that you cannot do your personal tax filing until you've completed your business tax filing. That's why your business tax filing is required to be filed before your personal tax filing. All right, because you can't, remember, you cannot complete your personal tax. People will go and try to start doing their personal taxes and forget that you're actually in business. You cannot complete your business tax filing until your personal taxes, you cannot complete your personal tax filing until your business taxes have been filed. Okay? Remember that, that's important. All right, and you know that you're going to look and see for your area where you actually file, where the tax filings go, if you actually sending these out yourself. All right, and so in this particular case, the personal tax form was going to Kansas City, Missouri, the IRS branch in Missouri, and the business tax form was going to Utah, if you guys can see that now. All right, it was going to the IRS department in Utah. All right, so it went to two places, and we let the IRS marry them up. All right, so again, guys, you want to make sure that you have a competent person preparing your taxes. Just want to reiterate that again. There is a difference between a tax preparer and a tax strategist. Tax preparer is someone, you just give them a bunch of papers, receipts and everything. They put everything together and just tell you to come sign and send a check or tell you how much money you're going to get. A tax strategist is looking at what you're actually doing in your business, and they're making recommendations to you. Well, Joe, you know, you sold 5 properties. I think that you need to create this, or we need to do this so that you can save some money on taxes here. If your tax person isn't talking to you like that, then you have a problem. You need to go find a tax strategist, all right? Because you can probably, if you're just working with a tax preparer, you probably can take your 10th grader or 10th through 12th grader, and they can do some tax preparation for you. And that's about what you're getting when you go to tax preparer. To someone that's preparing taxes. Remember what I said yesterday. If you're in this business and you're taking your taxes to H&R Block or the down the street place that says they do taxes and you get your rapid refund and all that, you're not serious about business. Okay, you need to find someone that's in this business, that's respectable in the business and can prepare your taxes properly. And guys, we got to get out of the mindset where we're trying to get our taxes done on April 15th. So before April 15th or January 31st, just as soon as we can get a W-2 so we can get our refund in